Right, so in this video, I'm going to talk about the second biggest objection that people have to borrowing against stocks. What if the stock market crashes and I get margin called? So this is one of the biggest factors that stop people from choosing to borrow against the stock market, because they just view the stock market as risky. And if it crashes and you have loans and you get wiped out, that terrifies people. However, I want to talk about why you should not be terrified of borrowing against your stocks, right? So it's not financial advice, it's just my opinion, and because I believe that financial peace of mind is not like a paid off mortgage. That's what people think it is. Financial peace of mind, true financial peace of mind is financial knowledge, 100%. Now, a margin call is a management failure, it's not a market failure, so it's not to do with the stock market. If the stock market crashes and you get margin called, it's your own fault because you did not manage your debt wisely. So, believe it or not, financial discipline is non-negotiable. What a surprise, right? To be financially successful, you need to be financially responsible and have financial discipline. And that could be whatever area of life you choose. It doesn't matter if you choose to set up a business. It doesn't matter if you choose to invest in the stock market. Whatever you choose to do, to have financial success, you must have some sort of financial discipline. So that goes without anything, without saying. So that comes number one. The easiest and most simple way to avoid a margin call, straight away I can tell you, is having a conservative low loan to value. Basically, don't borrow too much. Right? Don't borrow too much. If you borrow too much, the chances of getting margin called are higher. So if you have a £100,000 portfolio and you decide to just borrow 80 grand, okay, then the stock market doesn't need to even crash that much for you to get wiped out. Whereas if we say 10%, so 100 grand portfolio and you borrow 10,000, that's a 10% loan to value. That's much more conservative and responsible. So why would we borrow this 10,000 against the portfolio? Why not just sell the stocks? Sell 10 grand worth of stocks and you've got the 10 grand. You don't have to worry about this debt hanging over you. See, that's the way most people are trained. Most people are like, debt, don't want debt hanging over me. Debt's bad, debt's bad. You've been trained like, I want to pay off the mortgage as fast as possible. See, this is the opposite to how the ultra wealthy think. Because the ultra wealthy know how the money system actually works. They know not to sell an appreciating asset. Would you invest in the stock market if you didn't expect it to go up? Let me ask you that. Right? If you invest in the stock market, why? You're expecting the stock price to go up. Let's say you invest in the S&P 500. It goes up in value over time, over long enough time. It continues to rise. It always has done, and it always will do. It's a 100% success rate. It's undefeated. Why sell it? There's no point in selling it. It goes up in value. Whereas cash goes down in value. I like to use extreme examples when it comes to inflation. Right? Everyone knows what inflation is. What could 10 grand buy you like 100 years ago? Could probably buy you a house. And now it can probably buy you a decent car. So you understand that. You understand inflation. But why do you not apply it to debt? Because see, margin loans, they're far more competitive than like a bank loan is. People are so against it because they're so used to paying such high rates. A loan against a stock is not the same as a bank loan. It's not even the same as a mortgage. Mortgages can be potentially low interest rates depending on the environment, but it's not always the same, as margin loans are very competitive towards it. So you take out the 10,000, you allow your portfolio to continue to go up in value, while your debt goes down in value even without you paying it down, just because inflation exists. The value slowly goes down, as long as the margin loan rate, is either in line with inflation or just slightly above inflation. It depends obviously on the rate, okay? But you get the point of where I'm going with it. So to prevent a margin call, you borrow a very responsible amount of money. Remember, risk is a behaviour, it's not a tool. You can't just say margin loans and borrowing against stock is risky. Risk is the per individual's behaviour. This is what people forget. They just say, you can't just say, you can say, okay, a credit card is risky. but it depends who's got the credit card. You know, I believe that majority of people are just going to max out a credit card if you give it to them, but there is some people who can keep a credit card and pay the balance off every month. Okay, so it's down to the individual's behaviour. So it goes back to what I'm saying about financial discipline. The same applies to risk. It's a behaviour, not a tool. So we can't just say borrow against a stock's risky, right? So we have a conservative loan to value. So even if the stock market goes massive crash, we're still protected. It could crash 70%, we're still covered on a 10% loan to value. We can also have cash in the account. You can have cash as a reserve to protect in case you do need to add money to the portfolio. So you can have cash on the side, a conservative loan to value, and most of all, what are you invested in? Are you invested in stocks that are blue chip, or are you invested in sort of speculative, overvalued growth stocks? Because that's an also massive factor. You need to be, what are you borrowing against? A single stock, right? I can't help you with a single stock. How do I know if there's going to be a DOJ investigation on the company? What if the company's committing fraud? What if the CEO committed a crime or something happened? Like a single stock, anything can happen depending on that company. I don't know. So you're taking that risk. But that's why we focus on blue chip companies with clean accounting. Warren Buffett would often have this mentality. He wouldn't invest in big pharma companies, healthcare companies, banks, aviation. He stuck to like very clean, predictable businesses. And that's how he's made billions and billions and billions. And he did it over a long period of time. And he didn't interrupt his compound growth. He didn't sell the stocks. And he became a billionaire from it. You can do the exact same thing. You can invest in healthy blue chip companies. And rather than depriving yourself of all money for the rest of your life, you don't need to sell the stock. You can use a margin loan. And eventually, when you get to the stage of getting your portfolio to a private bank, it will not be called a margin call anymore. It will be called a security-backed loan. And they have a lot more leeway than a broker will. Like a broker's just automatic, like margin call, boom, it just happens. They don't even give you a chance. As far as I know, obviously I've not been margin called, or I wouldn't be making the video. Now, people are traumatized by previous crashes as well. 1929, the stock market crashed like 90%. So everyone has that in the back of their head. Oh, a market crash. The news constantly drives fear. You always see Bloomberg and CNN and CNBC like, oh, JP Morgan are saying there's going to be a recession this year and there's going to be a big crash this year. So when there's so much fear and uncertainty and noise, no wonder people don't want to borrow against the stocks, because they're driven by fear and anxiety. But I promise you, the more you know about the financial system and how it works and how you can track liquidity, you can invest the same way a bank does. You can actually arm yourself with the same information that many institutions use. And that's what I'm going to teach on this channel. Listen, 1929 can't happen again. The Fed did exist, but there was no QE, quantitative easing. They had no deposit insurance, there was no Basel III. 1929, it can't happen in 2025. Too much liquidity, Federal Reserve wouldn't allow it. It just wouldn't happen. There's just too much money circulating in the system now than there was in 1929. So don't worry about looking at these past crashes and saying, oh, but if that happens, I'll lose all my money. You won't, because you're balanced, you're financially responsible. If liquidity is high, even a black swan, like a pandemic, the stock market will recover. We can look, COVID is the perfect case study. What happened in COVID? Big pandemic, markets crashed, and it was the fastest bull run in history. $4 trillion was injected into the American economy. Stocks went flying up. So employment was like 13%. Employment was through the roof. Unemployment. People didn't have jobs, pandemic, chaos, businesses were closed down, but the stock market rallied. So how do you explain that? How do you explain that? How can you say the stock market rallied during a pandemic? That's because liquidity was just pumped into the markets. That's what pushes asset prices up. That's why inflation went through the roof, because a lot of that liquidity went actually to the individual citizens with stimuli checks, and they went out and spent so much money. Too much money going after too few goods is what drives the inflation up. So it was a short bull run, because eventually inflation got out of control, boom, Fed hiked the rates to calm it all down. Another black swan, tariffs. Tariffs were announced in early 2025, okay, early this year. I'm making this video and the tariffs crash was in April, and I was looking at liquidity, and liquidity was high and it was pumping, and there was so much fear in the markets. People were cashing out their 401ks and just chaos, right? Chaos. But if they just looked and tracked liquidity, they would have seen that, okay, liquidity is still expanding, this will recover, and it recovered massively. If you invested it during the tariffs, some stocks were up like 30-40%, like Microsoft, Nvidia's like 60% up. So this is why we track liquidity, and I'm going to make more videos on how you do that. But right now, you need to understand that the financial peace of mind is the knowledge. So the more you learn, the more you'll have less fear. People are afraid of what they don't understand. So people don't understand the stock market. They think it's gambling. They think it's risky. A crash can happen, but it's not always the case. Crashes happen, but if you track liquidity, we know the direction it's going in and what's going to happen. I'll give you an example of an actual liquidity crash. 2022. That was a liquidity contraction crash, and it was extremely predictable, but with the metrics that I track and I follow. Money market funds were parking their money safely at the Federal Reserve months before the crash, and I can show you all this in more videos, and you'll see just how clear it actually is. And the more you learn about financial information like this, the more successful you'll be, the better off you will be financially, the better your portfolio will perform, because you will stop selling your winners. You'll allow compound growth to actually function, and you're not depriving yourself like the FIRE movement, who don't sell until 40 years have passed. So there you go. Buy, borrow, die. That's what this channel's about. We track liquidity, we don't sell our stocks, we borrow conservatively during the correct liquidity environment, and we make sure we invest in quality blue chip stocks, real solid companies with real cash flow. If you like the video, leave a comment, like and subscribe. Thank you.